Hi guys, welcome to the second episode of us looking into what's happened in this week's economic data and also through this week's equity markets. I'm sure a lot of investors would have found the first episode quite useful, especially with Pinduoduo, Mercado Libre and gold all pushing on throughout the week. So we'll jump straight in with a look into the UK. GDP released this week. Numbers were pretty good. November GDP up 0.9%, which actually puts it above pre-pandemic levels. Construction being the main driver through October, November, and you also had upside surprises to both industrial output and your manufacturing output. I think for me personally, the real surprise came in retail trade, which added 1.4% to GDP. The reason I say that's a surprise is we've discussed previously about UK household savings. Savings are certainly dwindling away in UK households. So the fact that retail trade was up, you can kind of read between the lines and presume that spending is on the back of borrowing, which again ties in with increased borrowing numbers that we've seen in recent weeks. It's obviously not a good situation to be in when people are spending from borrowing. I think if you start kind of nailing down into the actual GDP numbers, the thing that would cause me the most alarm was that overall to the number 0.2% was added as a contribution from the UK's test, track and trace. Government spending is obviously a huge element of GDP. Some of it does help and some of it doesn't. When you're looking at healthcare spending, the general idea is you create a healthy workforce. That workforce then is more productive and output increases. Obviously that's not the case with test, track and trace, so you've got a 0.2% contribution purely on the back of spending, and yet it has a lot of negative implications, taking people out of the workforce rather than adding to output. Revisions are common in numbers. There was actually no revisions in this set of data from previous data, but I think you will see that on the next release. There will be a few revisions which will offer an overall downgrade. Always a busy week in the US. The real data kicked off on Wednesday of this week. CPI, inflation getting all the headlines, and rightly so. CPI month on month ahead of estimates at 0.5%, and this took year-on-year numbers to that key 7% level. We mentioned last week we were very much likely to see 7%, and sure enough that's exactly where it came in at. And last week's episode we touched on the real headaches that is now going to be causing the Fed. An overview to that number means CPI is rising the fastest it has done in 40 years.
Okay.
Again, we touched last week on the Fed's previous transitionary stance. The numbers really make quite a mockery of it at this point.
Yeah.
Because that is CPI exceeding 5% for 8 months straight now. Even excluding food and drink, the numbers still come in at 5.5%. It might seem crazy to not include food and drink in the numbers when essentially not everybody needs a new car, which is obviously seeing huge increases in prices, but everybody does need food and energy.
Sure.
The reason it's included separate is purely the volatility in the food and energy numbers. supply and demand imbalance continues. That's the whole trouble of it, and especially through durable goods. That's where we're seeing some numbers that really aren't expected to come back anytime soon. There's a lot of talk about how these numbers will subside. We're really struggling to see that at this point. You've had the Fed giving testimony all week about how supply chain issues will come back and will be fixed, but there's still really no solution in how this actually happens.
Yeah.
And on the back of that, you can just expect to see inflation elevated for some time to come yet. I mean, personally, I think we're in the region of at least another 2 quarters,
Okay.
possibly worst case through until the end of the year. The elevated inflation is really going to be held up on the back of your services sector, and notably rent increases and house price increases. People will be looking for signs of how that is going to play out and if there is any pullback. It's often not an overly used data metric, but it's becoming more and more important as the weeks go on. Your building permits, obviously if building permit numbers are up, it would indicate that there's been more houses being built, and obviously that alleviates some of the pressure on rent and your housing market.
Yeah.
And I think a key metric for people going forward that they really need to be looking at, and again it's an overlooked one, is your business inventories. Again, that's pretty simple. If inventories are up, you have companies holding more stock, and that would start to indicate that supply chain issues are being eased.
Okay.
And obviously vice versa the other way. If your business inventories are down, it's really showing that supply chain issues aren't letting up at all. The week ahead's quite a big one in terms of data, and we're going to get a lot of clues why a lot of people will still be sleeping in the UK. 3 o'clock Monday morning in China, we're going to get some real big numbers. Industrial output, that is going to be a key one, along with retail sales. And we all know how retail spending in Asia really stimulates quite a lot of the world. And then we've got GDP numbers from China. We expect this to be down at around about 3.6%. That's going to be a real disappointment. And that could set what could be a pretty tough week globally through equity markets. Purely on the back of that data release at 3 o'clock on Monday morning. Later in the day we have Eurozone inflation. Really not expecting any surprises there. Eurozone inflation will probably come in most likely at 4.9%. That is kind of priced in, but obviously the concerns remain. And then Wednesday we have UK inflation data. We think that's going to come in a bit worse than estimates. And again, that will impact UK markets midweek. We see RPI data coming in above 7%. Again, it's just the general pattern continuing of there's no real signs in inflationary issues subsiding. And then again, later on the day, on Wednesday, something we've just touched on is the building permits data and housing starts. Yeah, I think a final point of note, certainly as we look into the week ahead, is the valuation gap between equities and your bonds remains wide, to say the least. For many, there will still currently be no alternative to equities, even with rising yields. That's something I think you're going to touch on.
Yeah.
The valuation gap will still be very dependent on how the upcoming corporate earnings season looks.
Yeah. Hi guys, again this week I'm just going to touch on equities again, so we can just start there, John.
So as we kind of move into a look at equities, energy stocks have had a great start to the year. So I guess a really good starting point for this week will be looking at what's happened to EDF this week.
Right, so EDF is France's main energy provider, and it's not surprising that Europe is in the middle of an energy crisis. The French president has ordered the company to sell its power at a large discount, which will actually cost EDF $9 billion. It's a move to protect France's domestic needs, which will also allow them to export to neighboring countries. The news wiped 20% of price, although it did bounce back 10% by the end of the week. It's certainly not a buy the dip situation. In fact, a 10% bounce back values it ahead of where it actually should be.
So sticking with the energy theme for now, where are we at with BP and Shell?
Right, so BP's trading at a 52-week high, up 20% in January alone, while Shell has had 10% during the same period. Energy in general has got a little ahead of itself. We forecast 2021 year-end oil price at $67 a barrel, and pushing on to $85 during 2022. We're pretty much there already, and you'll see price stabilizing at this point. We've got real concern about over BP at this price. Their move to green energy has come to a cost in the last through the last 12 months, vastly overpaying for green assets. We also consider Shell overpriced. They're doing a great job at rolling out EV charging solutions, and asset price is riding the sector hype.
Financials have also had a really great start to the year, especially from kind of the beginning of the trading year in January. Where are we at with them?
Right, so we've been strong financial over the last 2 quarters, but anybody who's now been stripped. Barclays up more than 6% in January, along with HSBC, while Lloyds has added 20%. They've certainly had ideal market conditions, but we're about to find out if they can justify the move. Banks kick off earnings season in the US. JP Morgan reported Friday, and although numbers were strong, it wasn't enough to hold gains, losing actually 6% on the day. Next week we will have Goldman Sachs, Bank of America and Morgan Stanley reporting, and we expect to see the trend continuing. This will impact UK banks obviously in the same way, and now is actually a very good time to get out ahead of their reporting period. Lloyds Short offers a lot of temporary value.
It wasn't just JPM that struggled towards the end of the week in some of the major blue chips though.
Right, so Starbucks, Home Depot, McDonald's, Nike and Disney all had a rough week. Disney is now 10% down, 12 trailing months, but you can expect further pullback before it gets better. We like a lot of what Disney does, but market condition for a lot of its business has been far from ideal, and a smooth 2022 will only see 7.4 billion of net income. That's still $1 billion short on 2019 levels, when market cap was actually 20% less. We will actually happily pick up Disney, but we'll want it a touch under 140. Home Depot is the standard overpriced asset, up 40% in the 12 months. They could be a real shock on its quarterlies due February. We not only have revenue flatlining for the year, but for the next 2 years. You can as well expect institutional dead money sell-off.
Yeah, from my point of view, this is, I think, a pattern we're going to see repeating previous earnings seasons. You've had companies being judged to very, very low standards, and estimates out by a long, long way in a lot of cases. Obviously, asset prices have boomed across the board since then, and I think during this season, companies are going to be held to a higher standard and asked to really justify their price movements in their earnings.
Yeah, I totally agree, yeah.
Is Evergrande worth talking about? We've had updates on the defaults this week and also a mention of extensions to upcoming debt.
It's actually not worth talking about it. They can't pay their debt. They won't pay their debt for now. People seem happy pretending it's not happening. Going ahead, it will be a far more problem than Omicron is, and it's a ticking time bomb that we will face in the coming months.
We've had some questions this week from people who watched the first episode, basically wanting our thoughts on crypto, in particular Bitcoin, and also the relationship between the FTSE and the relationship it has between US markets.
Thanks for your question first. I'm gonna get quite a lot analytical on this, so just try to bear with me. So Bitcoin is still incredibly difficult to deal with on the quants front. We can dispel one myth that it's a hedge against inflation. Looking at statistical significance, it's never been and is unlikely to ever be. Again, looking at statistical significance, again, it's exposed to the Nasdaq and wider growth stocks. We can only hypothesize why, and you're likely to be looking at investor profiling. New crypto money has been shaken off in recent price decline, but early adopters were unwilling to get out at higher levels, and certainly won't be now, which is why you will see declines at a lower speed. Likewise, there's no need for early adopters to see this as a buy opportunity. Big and new money will see too great a risk. This leaves Bitcoin in limbo for now. Price will certainly get lower, as does being held by Nasdaq positions. Need to further liquidate the position, crypto positions. Institutional adoption is a must. We could see bigger calls for this at levels around 34,000. Over longer horizon, we are Bitcoin bullish.
So to round off this week's episode, that just leaves the relationship between the FTSE and the US. This one's got a bit complicated lately. Hope you've got your notes handy.
I do have them with me. Bear with me. So on a quants level, we were always able to model different indices econometrically using meteor shower. Essentially, signal sends from Asia at the end of trading day into Europe, and from Europe into the US. For the past 12 months, this has no longer any statistical significance. What does hold up though is heat wave effect, which essentially is retained mathematical momentum within an index. The FTSE has been subject to this for a period of time now, which has only lost its statistical significance in the last week. The FTSE has many correlations to the US rather than exposure right now. A bit like what I've mentioned earlier on with the expected banks movement, around a quarter of UK assets movement is attributed to US developments. The FTSE has had a 3-week move, it simply can't hold anymore, and March and forecasts are considerably lower where we are actually now.
Well, that's it for another week. Thanks for watching. We do take your comments on board. As you can see, we've kind of fixed the layout issues this week. We've tried. We've tried. We've gone the opposite side of the office. We've gone landscape mode rather than portrait mode. And we've got rid of the sunlight issues in the background. So we are learning. We try and make it better. But on the whole, it's really the content that we hope is going to be really useful to you guys. Like I say, there was some real good information for last week, and we've got all the reasons to believe again that will be the case going forward this week. Any questions? Get them to us through the various methods, and that's something we can look into for next week's edition.
Yeah.
Did they still have to do that whole like, subscribe thing?
I guess, yeah, same thing.
Yeah.
Yeah.
Yeah, thank you very much.
Thank you.